Imagine you're about to buy your dream house. The bank offers you a mortgage at 6.5%, and you naturally wonder who actually decides that rate. Most people assume it's the bank or maybe the government. But the real answer is much more intriguing. Behind the scenes, there's a massive, often overlooked market quietly pulling the strings: the bond market. This market doesn't just affect banks, it influences the rates on mortgages, car loans, and even the cost of borrowing for businesses and governments. Understanding this hidden force is the first step to grasping why money can suddenly become cheap, expensive, or hard to get. What exactly is the bond market? Think of it as a giant marketplace where governments, companies, and organizations borrow money, not from banks but directly from investors. In return, they promise to pay interest regularly and repay the original amount later. The US government sells treasury bonds, big companies issue corporate bonds, and riskier companies offer high-yield bonds. While the basic idea sounds simple, the bond market's influence is anything but boring. It's the engine room of the financial world, quietly shaping the cost of money for everyone. Bond is really just an IOU. When a government or company needs cash, they issue a bond to investors. In exchange, investors get regular interest payments and the promise of their money back in the future. For example, if you buy a $1,000 bond with a 2% interest rate, you'll get $20 a year. But what happens if new bonds start offering higher interest rates? Suddenly, your old bond isn't as attractive and its price drops. This simple relationship between interest rates and bond prices is the key to understanding the bond market's power. Here's the crucial rule: when interest rates go up, existing bond prices go down. When rates go down, bond prices go up. Let's say you own a bond paying 2% interest, but new bonds pay 5%. To sell yours, you'd have to lower the price to make it appealing. This seesaw relationship explains why the bond market reacts so dramatically to changes in interest rates. It's not just about numbers, it's about supply, demand, and competition for the best return. Now let's focus on the most important bond in the world, the 10-year US Treasury. This single bond acts as a foundation for countless financial products. Banks use its yield to help set mortgage rates. Businesses look at it when borrowing money. Investors use it to judge risk across the entire economy. When the yield on this bond rises, borrowing costs everywhere tend to go up. When it falls, loans become cheaper and more accessible. Mortgage rates are closely tied to the 10-year Treasury yield. When Treasury yields drop, banks can offer cheaper mortgages, making it easier for people to buy homes. When yields rise, mortgage rates climb and buying a house becomes more expensive. This connection explains why the bond market has such a direct impact on everyday life, from home ownership to monthly budgets. During the early 2020s, interest rates were at historic lows. Mortgages became incredibly cheap and people rushed to buy homes. Housing prices soared as demand surged. But this boom didn't last forever. When inflation picked up, central banks raised interest rates and mortgage rates jumped. Suddenly, buying a home became much harder and the housing market cooled off. The bond market's influence was felt by families everywhere. For decades, bonds were seen as the safe, stable part of an investment portfolio. Stocks were risky, but bonds were supposed to be reliable. Investors counted on bonds to protect their savings, especially during turbulent times, but as we'll see, even bonds can surprise you when interest rates change quickly. In 2022, central banks around the world raised interest rates rapidly to fight inflation. As rates climbed, bond prices fell sharply. Many bond funds suffered their worst losses in decades. Investors who thought bonds were always safe were caught off guard. This was a wake-up call. Bonds carry risks, especially when interest rates move quickly. The lesson from 2022 is clear: bonds aren't risk-free. They carry something called interest rate risk. When rates rise, bond prices fall and investors can lose money even if the bond itself is high quality. Understanding this risk is crucial for anyone who owns bonds or bond funds. One key measurement for bonds is called duration. Duration estimates how sensitive a bond's price is to changes in interest rates. A short-duration bond might only move a little when rates change. A long-duration bond can swing dramatically. The longer the duration, the bigger the potential price swings. This concept helps investors understand and manage their risk. Let's see duration in action. If you own a short-duration bond, a rise in interest rates might cause only a small drop in price. But if you own a long-duration bond, the same rate increase could lead to a much bigger loss. That's why understanding duration is so important, especially when rates are changing quickly. Real-world example of duration risk happened with Silicon Valley Bank. The bank held large amounts of long-term bonds. When interest rates rose quickly, those bonds lost significant value. At the same time, customers started withdrawing their deposits. The combination created a crisis that led to one of the biggest bank failures in US history. The bonds themselves weren't unsafe. The timing and exposure to interest rate changes caused the problem. The Silicon Valley Bank story shows that timing is everything. Even safe bonds can become risky if you need to sell them when prices are down. Interest rate risk isn't just about the bond itself, it's about when you need your money and how the market is moving at that moment. Bond market doesn't just influence banks and investors, it can even shape government policy. In 2022, the United Kingdom saw this firsthand. Investors reacted negatively to a proposed economic plan, causing government bond yields to surge. Financial markets became unstable and political pressure mounted. Within weeks, the country's leadership changed. The bond market had spoken, and even powerful institutions had to listen. When investors lose confidence, bond markets can force even governments to respond. Higher yields mean higher borrowing costs for governments. If investors demand more return for their risk, it can quickly impact public spending, taxes, and economic policy. the bond market's influence reaches all the way to the top. Today, national debt levels are extremely high in many countries. As debt grows, interest payments take up a larger share of government budgets. When bond investors demand higher yields, governments face rising borrowing costs. This can limit spending on public services and force tough choices about taxes and programs. The bond market's impact on government budgets means it can influence everything from social programs to infrastructure spending. When borrowing costs rise, governments may need to cut spending or raise taxes. The bond market quietly and indirectly shapes the choices that affect millions of people. So why should regular people care about the bond market? Because it quietly determines the price of money. Mortgage rates, car loans, and business loans are all linked to bond market conditions. When you understand this connection, you can make smarter decisions about borrowing, investing, and saving. Interest rates aren't just random numbers, they're shaped by the bond market's supply and demand. When investors want more bonds, rates go down. When they demand higher returns, rates go up. This is why understanding the bond market helps you see where rates might be headed and how that could affect your wallet. There's a big difference between owning an individual bond and a bond fund. If you hold a single bond until it matures, you'll likely get your principal back as promised. But a bond fund buys and sells bonds all the time, so its price can fluctuate with the market. Knowing this difference can help you manage your investment risk. Many investors take on interest rate risk without realizing it. Duration is the key to understanding how much your bond investments might move when rates change. Always check the duration of your bonds or bond funds to know what kind of swings you might face. It's also important to compare where your cash is stored. Sometimes, savings accounts offer very little interest, while treasury bills or money market funds pay much more. By paying attention to the bond market, you can make your cash work harder for you. Long-term treasury yields often provide valuable clues about the economy and borrowing conditions. When yields rise, it can signal higher inflation or economic uncertainty. When they fall, it may mean investors expect slower growth. Keeping an eye on these yields can help you anticipate changes in the financial landscape. You don't need to become a bond trader to benefit from this knowledge. Just understanding the basic rules of the bond market can help you make better financial choices. Whether you're buying a home, investing for retirement, or just saving for the future, the bond market's influence is always there. The bond market doesn't just affect loans, it also shapes home prices. When mortgage rates drop, more people can afford homes, pushing prices up. When rates rise, fewer buyers can qualify and prices may fall or stagnate. This is why the bond market's movements ripple through the entire housing market. Businesses also rely on the bond market to grow. When borrowing is cheap, companies can expand, hire more workers, and invest in new projects. When borrowing costs rise, growth slows, and companies may cut back. The bond market is a silent partner in business success or struggle. Retirement accounts often include bonds for stability, but as we've seen, bond values can swing when interest rates change. Understanding how the bond market works can help you build a more resilient retirement portfolio and avoid unpleasant surprises. Even government decisions are shaped by the bond market. When borrowing costs rise, leaders must rethink budgets, spending, and even policy priorities. The bond market acts as a financial referee, forcing tough choices and keeping governments accountable. At its core, the bond market helps set the price of money itself. When the price of money changes, almost everything else in the economy shifts with it, from home prices to business investment to government spending. That's why the bond market is so powerful, even if it's rarely in the spotlight. Once you understand the bond market, financial news starts to make a lot more sense. Headlines about rising yields, falling bond prices, or central bank moves are really about the cost of money and its ripple effects. With this knowledge, you can see the bigger picture behind the news. Many people believe the bond market is boring or only for experts. In reality, it's one of the most important forces in the financial world. Whether you're an investor, a homeowner, or just someone with a savings account, the bond market affects you every day. Bonds and stocks play different roles in your financial life. Stocks offer growth but come with more risk. Bonds are meant to provide stability, but as we've seen, they're not immune to losses. Balancing both can help you build a stronger, more resilient portfolio. Inflation is a major factor in the bond market. When inflation rises, investors demand higher yields to keep up with the cost of living. This pushes up borrowing costs for everyone. Watching inflation trends can help you anticipate changes in bond yields and interest rates. Central banks like the Federal Reserve play a huge role in the bond market. By raising or lowering short-term rates, they influence bond yields across the economy. Their decisions can spark big moves in borrowing costs, investment returns, and even stock prices. It's not just mortgages, car loans are also affected by the bond market. When bond yields rise, auto loan rates tend to go up too. This can make buying a new car more expensive and slow down auto sales. The bond market's reach extends to almost every corner of the economy. Businesses depend on affordable loans to grow and invest. When bond yields rise, business loan rates go up, making it harder for companies to expand. This can slow job growth and reduce investment in new ideas. The bond market's influence is everywhere. Even your savings account is affected by the bond market. When bond yields are high, banks may offer better interest rates on savings. When yields are low, savings rates often drop. By understanding this connection, you can make smarter choices about where to keep your cash. Retirees often rely on bonds for steady income, but when bond prices fall, their portfolios can take a hit. Understanding how interest rates affect bonds can help retirees protect their income and adjust their strategies as markets change. When governments face higher borrowing costs, they may need to raise taxes or cut spending. The bond market's influence on public budgets can lead to changes in tax policy, affecting everyone from workers to retirees. It's another reason to pay attention to bond market trends. The bond market is a key driver of economic growth. When borrowing is cheap, businesses and consumers spend more, fueling growth. When borrowing costs rise, spending slows and the economy can cool off. The bond market signals often predict where the economy is headed next. Policymakers watch the bond market closely. Sudden moves in yields can force governments and central banks to change course. Whether it's adjusting interest rates or rethinking budgets, the bond market's reactions can drive major policy shifts. The bond market isn't just a U.S. story, it's global. Changes in U.S. Treasury yields can affect borrowing costs around the world. International investors watch the bond market for clues about global growth, inflation, and risk. Its influence truly knows no borders. Most people never learn how the bond market works, but it quietly shapes almost every aspect of the economy. From home prices to government budgets, from business growth to your own savings, the bond market is the hidden force behind the scenes. Understanding its rules gives you a powerful advantage. Here's the big lesson: you don't need to be a bond trader, but you should understand the bond market's basic rules. It quietly determines the price of money, influencing everything from home loans to government policy. Once you know how interest rates and bond prices interact, financial news and economic trends become much clearer. The bond market may be quiet, but its impact is everywhere.